Hi, this is Kunal Khanna, and thank you for the fantastic response for our previous video where we interacted with Gaurav Mehta, our CIO alternates. It's been 7 years since you've invested, a lot of you have invested in our SBI ESG PMS, and we've come back this quarter with a new set of questions for Gaurav. Welcome to this interaction, and we have a set of questions for you. SBI ESG PMS has actually completed 7 glorious years in July this year. And this last quarter has been very volatile as far as the market is concerned. So we've moved to a lifetime high. We've seen some bit of correction that's come in because of the FIs, selling some amount of equity in emerging markets. So what do you gauge? If I am an investor in ESG, I've done very well over the last 7 years. Right? Should I be booking some profits? Should I be staying investing? Should I be bothered with the short-term volatility, or should I stick to my asset allocation?
So Kunal, markets always are volatile, and they go through their own cycles. There is something on tactical asset allocation, and there is something called structural asset allocation. Now, if you think of it from a here and now point of view, then obviously there are two key factors that determine stock prices, right? One is valuations, and the second is earnings. Eventually, price is equal to PE into earnings, right? So earnings and valuations are two important determinants of near-term market moves. And the third factor that also plays an important role is market sentiment. You should be a contrarian investor, you should be greedy when others are fearful, and vice versa. And these three components we've tried to sort of quantify in our asset allocation framework. At this point in time, if you think of earnings, that picture is actually quite optimistic, right? Because we were in a bit of an earnings lull for a good 10-12 year period between 2008 and 2020. And the simplest way to measure that is to look at profits to GDP in India. And between 2008 and 2020, we fell secularly from about a high of 7% plus to a low of less than 2%. And it's only over the last 2-3 years that earnings cycle has reversed for the better. And usually these trends last a few years, if not more. And to that extent, I think we are still in early stages of an earnings expansion cycle in India, if you were to take a 3-5 year long view. And in that context, valuations, yes, they are expensive at this point in time, because some of that earnings improvement is already being front loaded in stock prices as we speak. But if those, that earnings delivery continues over the next few quarters and years, then obviously the near-term valuation expensiveness will take care of itself. Similarly, market sentiment at the current juncture does look a little, lofty, to the extent that there is more greed in the market than fear. But again, these near-term valuations, near-term sentiment excesses is something that correct themselves in a relatively short period of time. And these cycles usually should and have never impacted the long-term return expectations for investors. So to that extent, I think the long-term outlook still, if you're an investor with 3+ year kind of an investment time frame in equities, the fact that earnings are still reverting higher is a positive news. And to that extent, to the extent that valuations are expensive, you should calibrate your return expectations. But you are still in for good returns from equities, short-term volatility notwithstanding. And with respect to the longer-term asset allocation, I think none of what I just said should matter for investors from a longer-term asset allocation standpoint, right? So just continue sticking to your asset allocation discipline and keep a 3-year plus kind of an investment time frame.
True. So that actually makes a lot of sense, because if I am a long-term investor, I actually invested in a product with a 4 to 5 year kind of a view. And if I keep trying to time the markets in the short term, all that's going to do is amount to capital gains for me. So what you're saying makes a lot of sense, that we are seeing earnings which are very robust, and if P is price upon earnings, if earnings actually increase, the P automatically over a period of time will actually contract. So that makes a lot of sense. Second question, Gaurav, because this is a PMS which is based on the theme of ESG, where we're focusing a lot on sustainability, right? Sustainable investing globally is a very big theme. It's in very nascent stages in India. SEBI's actually asked in the previous board meeting companies to come out with more disclosures as far as ESG is concerned. But what we're actually seeing, because the performance on a 5-year, 7-year, 3-year basis is phenomenal as far as the product is concerned. 1 year shows some bit of underperformance as far as the ESG PMS is concerned. Now, is this because ESG as a product is a product where there are a lot of buffers that are built in because of the environment, social responsibility, corporate governance factors, and whenever, as you mentioned, there is some amount of euphoria, it takes a back seat to some extent, and that's the reason for the underperformance? Or how would you rate this 1 year underperformance that we're actually seeing in the ESG?
I mean, absolutely fair question at this point in time, Kunal, because I'm sure a lot of investors will be thinking of that as well. But I'll break this into two parts. The first part is, with respect to ESG. Is ESG a factor contributing to the short-term underperformance? I think not, because there are different ways that you can run an ESG strategy. The way we run the ESG PMS is to follow an exclusion-based strategy, where we will exclude certain sectors which are non-ESG in nature, like tobacco, fossil fuels, etc. And at the same time, from all the remaining sectors, we'll exclude companies, which, let's say, from, as a matter of speaking, and to keep it very simple, let's say we'll exclude the bottom 1/3 of all other sectors also, basis their ESG scores. So sectors which are poor on ESG get excluded, and then from remaining sectors, companies which are low on ESG scores also get excluded. But that still leaves us with a large majority of ESG investable stocks, and which is why when you look at the sector output of the ESG PMS, it's fairly diversified across sectors. So a lot of people have this view that when you're thinking of ESG investing, you are essentially following a best-in-class ESG investment practice, wherein you would end up with a portfolio which is very skewed towards renewables and green energy and so on. And in that case, the portfolio can actually become prone to cycles, because those sectors may or may not be in favor at any point in time. But the way we run ESG is not at all that. We are not skewed towards any of these ESG friendly sectors. It's a very well diversified sector mix. All we are doing is to remove companies and sectors which are unsustainable from an ESG point of view. And to that extent, we think that gives you a good combination of we also have some skew towards mid and small caps. So you're investing in smaller companies, and you're putting a layer of sustainability that allows you to benefit as these companies grow older and they sort of mature. But at the same time, it also allows you to remove any accidents that usually come from small cap investing because of that layer of sustainability. Now the question is, then why then has the last 12 months experience not been as good as has been, let's say, the last 3-5 year experience? And I think the factor for that is that in general our portfolio is when you're constructing these portfolios, we're thinking of superior earnings growth for the next several years. But as we do that, we also are very conscious on quality aspects, right? So we are looking at companies which are high on ROEs and low on leverage. And when you think of this combination, high growth, high ROE, low leverage, essentially a lot of these companies tend to be low beta in nature also. So all they need is time for earnings to be delivered and for stock returns to follow those earnings. When there's a sharp move in the markets, either ways, because of the low beta, they don't sort of mimic the market moves. In any case, we run a very high active coverage, more than 70-75%. So there's very little overlap between the index and the portfolio. And which is why in short periods there can be significant deviations from the index either side. I think that's what is playing out over the last 12 months. But if you go back in time 12 months ago from now, at that point when markets were very turbulent, this was amongst the best performing funds. And which is why even today, when you look at the last 3-5 year return experience, it's been fairly good. But yeah, I think that low beta, that high quality bias is something that, and the high active coverage is something that makes the portfolio deviate from what's happening at the index level on very shorter term time frames.
So again, Gaurav, as far as the Indian markets are concerned, we've seen a huge shift from growth to value, and a lot of growth-oriented stocks and a lot of products which were growth-oriented products have actually seen a lot of underperformance in the last couple of years. A lot of companies which are more on the value-oriented segment, a lot of companies which are more on the commodity segment, companies which leverage a lot have been doing very well. What are the changes that you are making to SBI ESG PMS in the last couple of years, and how are you repositioning this PMS so that it does well over the next 3 to 4 years?
Right. So Kunal, the way we think about this portfolio is that we are essentially looking for businesses which can grow at a very fast pace for the next several years, right? So the earnings growth should be strong, and the longevity of that earnings growth should be high in terms of number of years. And when you're doing that, you're not consciously thinking so much about whether the portfolio is biased towards value as a style or whether it's biased towards growth as a style and so on. That said, we are very conscious of valuations. And if you look at the exits that we made over the last 3 to 6 months, there have been a few companies that we've actually liked for the last several years, and they've been good compounders for us. In fact, some of them have given multi-bagger returns as well. But we had to exit them for the simple reason that we thought that from these valuations, even if that earnings compounding comes through, the stock returns may still not look as robust. And to that extent, we have not turned a blind eye to valuation. We have been conscious on valuations and exited those companies. That said, this is not a portfolio which is very defensive in nature with respect to the sectoral biases and so on. So to your question on how are we thinking of the next 3 odd years, I think there are two themes that we think should work very well in India. The first theme is obviously this entire manufacturing where, there's a concerted effort on the part of the government. There's confidence in corporate India, there's clean bank balance sheets, and then the entire geopolitical situation is also sort of evolving in favor of India. Where we think that manufacturing as a theme should do very well, and then there are different ways of playing it: industrials, garment manufacturing, lending, and so on. So there's one pocket that you will see that the portfolio has a decent representation of, and the second pocket that I think should do well, again from a 3-5 year standpoint, is the fact that we are at about $2,200-$2,300 of per capita GDP, and as economies move higher from that $2,000 to $3,000 kind of a per capita GDP number, you've seen that discretionary consumption benefits very non-linearly. Similarly, investment and saving products also tend to benefit as per capita GDP increases. So discretionary consumption and investment and savings is one pocket that should do well over a 3-5 year time frame. And again, when you look at the portfolio, you will see that there's a good skew of the portfolio towards those plays as well. So this combination of manufacturing on one hand and discretionary consumption and investment products on the other hand is something that we think that should hold the portfolio in good stead for investors over the next few years.
So as an investor, I can actually be confident that there's a professional looking at my investments in the right way. Right? So he's shifting whenever the shifting is required from a large cap to a mid cap to a small cap, or maybe from a growth to value. That's actually been taken care of by the professional team at SBI Funds Management. That's great to hear from an investor perspective. The last question, Gaurav, is, and this is actually being spoken about a lot in the social media as well, the disadvantage that PMS has as far as taxation is concerned over mutual funds, which actually is a fact, right? Because even if I'm not withdrawing money, if the churns in the portfolio are very high, it's going to hit me at the end of the year as far as taxation is concerned. Now, obviously, there are 350 PMSs. Everyone will have their own style of functioning. How do you go out and ensure that taxation does not hit the investors? Because at the end of the day, what we're trying to do here is keep a portfolio, crisp portfolio of 20 to 25 stocks. I think currently we have 22 stocks in the portfolio. So again, do we keep changing stocks? Because only when you sell a particular stock will you buy a new stock. So how do you balance the entire thing out where we don't hurt the clients as far as the taxation is concerned?
Right. So I think any investment product, whether it's a mutual fund unit or it's a stock, or for that matter investing in PMS, if you are holding those investments for the long term, then the tax incidence goes down. If you're churning a lot, then the tax incidence is the same, right? If you churn it within a year, 15%. If you churn it beyond 12 months, then obviously 10%. But yes, I mean, within the wrapper of a mutual fund, if the fund manager makes any transactions, they don't have to pay any taxes there. But on a PMS product, you do have to do that. But I think, which is our approach in any case has been to look for companies where you can ideally hold them for 3-5 years, if not longer. In most cases, even longer than that. And that in turn translates into relatively low churn numbers on an annual basis. So the turnover of the portfolio is quite low. And again, this is you're talking about that question on value growth, etc. So it's not that we are making those big shifts depending on the market circumstances, etc. We are bottom-up investors who are looking for good businesses to hold for the next few years, right? And that essentially brings with it a longer holding horizon, which in turn translates into low portfolio churn. And to that extent, we don't think that is something which is very punitive here versus any other investment product that you're investing in. The flip side of it, obviously, which is a positive aspect of investing in a PMS, is that today when you look at the AUMs for a lot of conventional mutual fund schemes, have become very large. And which is why the universe keeps it keeps shrinking, right? Because your ability to exploit a tail of small cap ideas in a big AUM sized mutual fund is obviously limited. And to that extent, in a PMS where sizes are usually much more sort of constrained, your ability to play these smaller ideas is that much higher. And some of these stocks, will obviously grow non-linearly and become mid caps and large caps of tomorrow. So your ability to participate in them through a PMS product, and then sort of hope for non-linear or at least some excess returns versus a conventional product is also higher. And that, I think, more than sort of compensates for any here and now taxation differences. So yes, I mean, every product has a pro and con, but on balance, we think that PMSs give you a flavor that you will not get from conventional products.
Fantastic. So I'm sure, after this interaction, a lot of you all would have got a lot of confidence that there is a professional team managing this entire show. And, as promised, we will come back every quarter. So next quarter, we'll be back with a new set of questions for Gaurav as far as your investments in ESG PMS is concerned. Thank you for watching this video.